All right, let's take a look at some example problems from Chapter 18, Managerial Accounting Concepts. These problems will help us apply what we are learning in the chapter, and the example problems here will help you when you complete your homework assignment. This first problem is going to have us classifying cost and then computing a cost per unit. So what they've listed here are costs associated with the production of 1,000 drum sets that were manufactured by True Beat. We are going to classify each of these costs and its amounts as either a product or a period cost, and they have done the first item for us as an example. Okay, so remember, they are building drums. Any plastic cost that they incur that they use to make the casing, that is going to be a cost of the product, right? Because they can't make the drums without the plastic. So we will list that as a product cost. Okay. Now let's look at the wages of the assembly workers. The only reason they have assembly workers is because they are making the product. If they weren't making the product, they wouldn't need the assembly workers. So we know that is going to be a cost of making the product. Okay. So we will list that in the product cost column. Property taxes on the factory. Any cost they incur because of the factory is going to be a cost of making the product, because they wouldn't have a factory if they weren't producing the product. So that is going to be a cost of making the product. We will classify it as a product cost. The office accounting salaries. The accounting department has to account for not just the production department, the manufacturing area of the company, but the accounting department also has to account for all of the other transactions for sales and other operations in the business. So the accounting staff is not a cost of making the product, it is a cost of the period. They have those costs for this period of time. So it is not a product cost, it is a period cost, right? And the easy way to think about it is if they weren't making the product, they weren't manufacturing it. Instead, if they were just going out and buying the product and then turning around and selling it, they would still need an accounting department. So they would still have the salaries of the accounting staff. So that is not a product cost, that is a period cost. Okay. Drum stands. Drum stands are a cost of the product, right? Because if they weren't making the drums, they wouldn't have to have drum stands, right? So, they bought the drum stands in order to be able to make the drums. So that is going to be a product cost. Rent costs of the office for the accountants. Again, the only reason they need an office space for the accountants is because they have an overall business that not only makes the product, but they also sell it. Then they have all their other normal day-to-day operations, right? So the accountants are not a cost of making the product. They are what we call a cost of the period. So that would be a period cost. Office management salaries, similar to the office accounting salaries, if they weren't making the product. If they were going out and buying it, again, they would still need an office management. They still have an office. So that is not a cost of making the product, it's a period cost. Annual fee for factory maintenance. Only reason they have an annual fee for the factory maintenance is because they have a factory to make the product. So that is a cost of making the product. If they were not making the product, if they were going out and buying it, then they wouldn't have a factory. So they wouldn't have that annual fee for maintenance. Okay. Sales commissions. Sales commissions are not a cost of making the product. They're a cost of selling. So if they weren't making the product, they would still need a sales department. So even if they got rid of the factory, they would still have to pay their salespeople, right? Their salespeople would still be going out and selling. They would just be selling what they bought instead of what they made. So that is a period cost. Factory machinery depreciation. The only reason they incur depreciation cost is because they have a factory where they're making the product. Thus, it is a cost of making the product. It is a product cost. Okay. Ultimately, what it comes down to when classifying costs is either a product cost or a period cost. If the cost has anything to do with making the product, it's a product cost. You can ask yourself, if they were not making the product, would they still have this cost? And if the answer is yes, then you know it's not a product cost, it's a period cost. All right, hope that helps. The second part of this is asking us to calculate what the average manufacturing cost is per drum set. What is it costing them to manufacture each inventory item? Well, to determine that, we only care about the cost incurred to make the product, the manufacturing cost of making the drums. So I'm going to bring all of those numbers down here. Total manufacturing cost incurred to produce 1,000 drum sets. So if they incurred factory related cost of 180 to produce 1,000 drums, 180,000 divided by 1,000 means it costs them $180 per drum set. Now we have the average manufacturing cost per drum set. Now that we have a basic understanding of product versus period, let's do this problem that has us looking at more detail about the different categories within product and the categories within period cost. So the following year information is taken from the December 31st adjusted trial balance of Leone Company, and they want us to identify each of these costs first as a product or a period cost. If it is a product cost, they want us to further classify it as a direct material, direct labor, or factory overhead. If it is a period cost, we are going to further classify it as either a selling expense or a general administrative cost. So advertising expense. The reason they advertise is so that they can sell. It is going to be not a product cost, it's going to be a period cost. So advertising expense is a period cost. We know it is not a cost of general administration, it is a cost of selling. Depreciation expense on the office equipment. Let's kind of look at these three together because it will help us differentiate. They have depreciation expense on office equipment, selling equipment, and factory equipment. The two items on office and selling equipment, those are not a cost of making the product. Those are a cost of the general office and a cost of the selling area, the selling department, their property, plant, and equipment. Those are not costs of making the product. They're a period cost. The factory equipment, however, that depreciation expense is a result of the factory where they are making the product. So it is a product cost. So depreciation expense on office and selling equipment, we know are period cost. The office equipment is not a selling period cost, it is a general and admin period cost. The depreciation expense on the selling equipment is a period cost, but it is a selling expense, right? It's not a general and administrative cost. Depreciation expense on the factory equipment, however, is a product cost. It is not a direct material cost. Those costs are not related to the materials that we use to make the product. It is not a direct labor cost. It has nothing to do with the labor that is making the product. Instead, it is an indirect cost of making our product. So we classify it as an overhead. Okay, remember, overhead costs are just indirect costs that we incur in the factory to make the product. Raw material purchases. All of these were direct materials. Okay, what they're telling us is they went out and bought materials that they are going to use to manufacture their inventory. All of those materials are direct. They're going to go directly into the product. Right away, we know if they're using these to make the product, it's going to be a product cost. And then looking at the categories within product cost, they are direct material cost, costs going directly into each item produced. Maintenance expense on the factory equipment. Okay. Again, these expenses relate to the factory where we are making the product. If it is a cost of making the product, right away we know it is going to be a product cost. The maintenance expense is nothing to do with the materials going into the product. It is not the labor making the product, so it's not a direct labor. It is an indirect cost of making the inventory, right? Because we have to make sure that the machines are operating in order to make the product. So those costs relate to the product, but they are not directly part of the product. They are indirect costs. They are indirectly a cost of making that product. It's the same thing with factory utilities. We cannot make the products without having electricity in the factory, but those costs are not a direct material or a direct labor cost. They are indirectly a cost of making the product. Okay? So these indirect costs are what we call overhead cost. Direct labor. Direct labor refers to the people that are physically making the product. So right away we know it's a product cost, and it's the direct labor. Those are costs associated directly with the product. But when we look at the indirect labor, again, that is still labor involved in making the product. But the indirect labor are going to be the supervisors. They are going to be the janitorial cleaning crew, right? That indirect labor is a cost of making the product. We can't have the factory making the product without the supervisors in the factory or the janitorial staff. So it's a product cost, but it's not directly a material or labor associated directly with the product. It is an indirect cost. So we call that an indirect overhead. So we classify it as a product overhead cost. Office salaries, rent expense on the office space, rent expense on the selling space. All three of these are all period costs, right? They have nothing to do with making the product. Office salaries and office space have nothing to do with selling. So we know that they are period costs, but they are not selling, they are gen and admin cost. So we will classify those as period cost, general and admin. However, the rent expense on the selling space, that is going to be classified as a period cost, but that's a cost of the selling department. So that is a selling cost. Rent expense on the factory building, again, that is a cost associated with the factory where we are making the product. It is going to be a product cost, and the rent expense is not a direct material or a direct labor cost. It is an indirect cost of making the product. So it will be classified as an overhead cost. Okay. And finally, sales salaries expense. Selling has nothing to do with making the product, so it is not a product cost, it is a period cost, and it is part of the selling department cost, so it will be a selling period cost. All right, this last problem, we are going to prepare a schedule of cost of goods manufactured, as well as an income statement. So internally, companies prepare this schedule of cost of goods manufactured to communicate to those who care within the company, what did it cost us to manufacture the product? So this problem has given us beginning and ending balances in the three inventory accounts: raw materials, work in process, and finished goods. They have also given us the amount of revenues. In addition to this information, we also need to use the problem data that we just worked with. So in the previous problem, we were classifying these costs. Now we're going to use all of this information with this information to complete the schedule of cost of goods manufactured. Okay, so first things first, three-line heading, looks like a formal financial report, like the income statement, statement of owner's equity, and balance sheet, right? But this is not. This is just an internal document. But we are reporting what was the cost of the goods manufactured for the year ended December 31st. This report is going to communicate what were our direct material costs, what were our direct labor costs, and what were our factory overhead costs. Again, the three costs of making a product. All right. So let's start with direct materials. We are going to report what were the costs of direct materials used by showing the flow of costs through the raw materials inventory account. They began the period with a balance in raw materials of $166,850. Okay? All of this information is just given to us. We just need to put it into this manufactured statement format. So started with this amount beginning inventory, reflecting materials we had purchased prior to this current year. Then during the year, we added some purchases. We bought more materials. So let's see where they gave us information. Oh, here we go. Raw material purchases during the year were $925. So we added those purchases to our beginning inventory balance, meaning we had $1,091,850 worth of raw materials available for use in the manufacturing process. This was the cost of all the materials available. If we were left with raw materials in the raw materials account of $182, subtracting what was remaining from the amount of materials that was available, the amount of materials used is the difference, $909,850. Beginning plus what we purchased tells us the total amount we had available, less what was still on hand at the end of the period. The difference is what was used in the manufacturing process. All right, so we have now communicated these were our direct material costs to manufacture the products we did. Another cost we incurred to manufacture is direct labor. In future chapters, we will see where that number comes from. In this chapter, they just simply told us our direct labor costs were $675,480. So we are going to communicate that in our cost of goods manufactured statement. Our third cost of making the product, factory overhead costs. Factory overhead are going to be all of the indirect costs of making the product. We had previously identified indirect costs, but going through here, I'm going to pick and choose only those indirect product costs, the overhead cost. So looking through here, period cost, period cost, period cost. Oh, here is a product indirect cost. So we will have depreciation expense on factory equipment. That is a direct cost already reported. That is an indirect cost. We will include that. And factory utilities, yep, that's going to be included. That is an indirect overhead cost. Direct labor already reported. It is a product cost, but it is not indirect. Indirect labor, that is definitely a product cost. Indirect overhead. Office salaries, nope, period cost, period cost, period cost. Oh, here's another overhead cost. Rent expense on the factory building. All right, so now I've listed all of my factory overhead. Again, in a future chapter, we will see a little bit more details about how we keep track of those amounts. Total indirect cost of making the product, $354. So now if I add the direct materials, direct labor, and overhead cost, total manufacturing cost, I added during this accounting period, during this year, $1,939,330. Now we only care about the cost of the goods that were fully manufactured and completed. So I need to take these manufacturing costs that were added to work in process and then show the flow of cost through the work in process account. If I add those manufacturing costs incurred to my beginning work in process account, that determines what is the total cost we have incurred for all inventory that we have been working on, that has been in process during this period. Some of that inventory was incomplete, which means some of those costs are still in ending work in process inventory. So I will subtract out those costs associated with incomplete inventory, still in the manufacturing process. The difference between total cost recorded for manufacturing inventory this period less the cost of the inventory still in process helps me determine the cost of the goods that are fully complete, manufactured, and ready for sale. Why are we doing this? Well, we know it costs us $1,935,650 to manufacture all these products, we then can communicate that to the sales department to help them determine what are we going to sell our products for. They need to set the selling price to be enough to cover the manufacturing costs plus all of the other period costs, selling and administrative costs. Okay, so this is super important to the company. Our job in the managerial accounting area is to provide this information. The last thing this problem wanted us to do is to prepare an income statement. Okay, so again, to prepare an income statement, we are going to report the cost of the inventory that we sold plus all of the other costs incurred during this period, the period cost. Right, so taking a look at Leon's income statement. They have provided us the amount of revenues given. Revenues for this year were $4 million and change. We break out the cost of goods sold, right? The cost of the inventory that we sold. In a manufacturing environment, those costs are associated with the inventory that was sold out of finished goods. So to show the cost of goods sold, we are going to demonstrate the flow of cost through the finished goods inventory account. We began the year with a balance in finished goods representing cost of inventory manufactured in a previous accounting period, ready to be sold. During the period, we add to that all of the cost of the goods we manufactured this accounting period, which we just calculated in our cost of goods manufactured report. Adding the cost of the inventory completed gives me the total cost of inventory that the company had available to sell during this accounting year. Some of that inventory was not sold because they have a balance in finished goods at the end of this year. So I'm going to subtract out the cost of the inventory that was not sold to calculate what was the cost of the inventory that was sold. The difference between our revenues and our cost of goods sold is our gross profit. Okay, and that's a concept you learned in your prior financial accounting course. That is the profit they made off of just selling the product. That's not profit, that's not net income, because in addition to the product cost, they also have the period cost. They have all of their selling and their general and administrative cost. So let's go back and redetermine selling administrative cost. Advertising, cost of selling. Depreciation on office equipment is going to be a general and admin cost. Depreciation on selling equipment, that is going to be a selling cost. Depreciation on factory, that's a product cost. Raw materials, product cost. Maintenance expense on the factory, that is a period cost. Excuse me, that is a product cost on the factory, ignore me. Factory utilities, product cost. Direct labor, product cost. Indirect labor, product cost. Office salaries expense, that is a period cost. It is a general and administrative cost. Rent expense on the office, also a general and administrative cost. Rent expense on the selling space is a selling cost. Okay, 26.1. And then rent expense on the factory, that is definitely a product cost, already included in our cost of goods sold, and our sales salaries expense. That is a period cost of the selling. So if I add up my selling expenses, they total $456.10. If I add up my general and administrative expenses, they total $92,250. So my gross profit less my selling and general and administrative costs means the company earned a net income of $1,947,730. All right, hope this helps. Reach out with questions.